So this topic is going to be about some differences between owner financing, a subject to transaction, and direct seller financing. So if you find this video useful, take a moment to like it, please. If you have any comments about this video or other videos you'd like to see, please comment below. And subscribe to our YouTube channel. So let's just take a minute and talk about owner financing, sub to, and direct seller financing. People keep confusing the two. Subject to, wraparound mortgages, and direct seller financing are all subcategories of owner financing. The difference is subject to is where there is an existing mortgage, of course, being left in place, in which the buyer is agreeing to make payments on that mortgage, but the seller is not being released from liability. Got it. On the other hand, we run across a lot of sellers who own their homes debt-free already, but they may consider becoming your bank and providing you a loan on the property to be secured by their property. We're going to run across both of these situations often in the marketplace, and having a good working knowledge of how they work, which one should I go with, at what time, and why, is very beneficial. Let's just take a subject to transaction for a minute. A lot of people ask, why would a seller ever do that? Well, if they're in trouble financially, behind in payments possibly, maybe the home is in disrepair, whatever it might be that precludes them from selling their home under a traditional retail basis. Maybe the marketplace is messed up and it takes way too long to sell the home and they don't have the time. They've been transferred, this, that. We could go through and talk about a myriad of issues as to why a seller would sell a home subject to the existing debt. Maybe the seller is actually current in the payments. They just want to get out and have to move. We had a client just recently who got transferred in a job all the way across the DFW Metroplex. They'd only been in their home for 2 years. They needed to move quickly. And they couldn't afford the 2 house payments that they had. And it was over an hour-and-a-half commute each way. No way they're going to do commuting for 3+ hours a day. They needed to move quickly. And even though they were current on their mortgage, they sold the home subject to the existing debt and left that lien in place. So even in situations like that, give a seller reason to sell their home using a creative finance subject to mechanism. Now on the flip side, we may run across a home that is owned debt-free by our seller. What I find interesting, especially in the realtor marketplace, is realtors think everybody should sell their homes for cash because they all want the cash. It ain't so. You have to take a moment and ask the seller what they really want. Certainly some sellers need the money out of their home because they want to buy another house. Some may want to use the cash for other reasons. But a lot of sellers really don't. If they got the cash, the most common answer you'll find from sellers when you ask where are they going to put the money is in the bank. And of course you ask the follow-up question, what's that bank going to pay you? And of course the answer is nearly nothing. That even holds true today as it did years ago and probably years in the future. That's why we have banks, is to collect and hold our money and pay us nearly nothing, it seems like. So if that seller knows that they can make a loan on their property, carry back an attractive interest rate secured by their own home, something they are familiar with and they understand, it really does turn on that light bulb upstairs when you present that opportunity to them. Maybe they need some cash up front. Maybe it's a $150,000 purchase. They need $50,000 in cash, but they'll be willing to carry back a $100,000 note. Could that be done? Absolutely. Maybe you've got access to that cash. Maybe you need to borrow it from a private lender that will be in a second lien position. But take a moment and simply ask your seller what their situation is. And I think you'll find that in many cases, sellers are not objectionable to carrying back a loan on their own home. It's not like being a private lender on a third-party property someplace, because they understand their home. They know what it is. They're comfortable with it. And when the loan that they give you is secured by their own property, it just makes that transaction and the conversation that much easier. So whenever we're doing a subject to transaction, we're doing a direct seller finance transaction, there are pros and cons to everything that's out there. Obviously, if we're buying a home from a seller subject to the existing debt, it's a little harder to explain that to the seller or to the agent, and especially if unknowledgeable real estate attorneys get involved, it makes it even more problematic. Whenever we're doing a subject to transaction, we've got to keep in mind there's a due on sale clause. That's an issue from an explanation perspective. There's also an issue that the seller is still liable on that debt until it's paid off. So the most important part of a subject to transaction, of course, is disclose, 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 to make sure everybody is going into that transaction with their eyes wide open. Now, typically, if we're buying a home subject to, there's a mortgage company involved. There's already an escrow account set up in 99% of the cases. We know that our taxes are current. We know that there's an existing insurance policy. So from there, it's just the ins and outs of the subject to business we have to understand and learn in order to put everything together properly. Now, flipping back over to a direct seller finance transaction, what are some little issues that can arise there? Well, first off, of course, is making sure we properly explain how this works to a seller, how they're secured and protected, and how they're going to make money. How, if we don't make payments, they could regain the ownership of their property through a foreclosure or maybe even a deed in lieu of foreclosure. Now, in a situation where a seller has no debt, it becomes more important to check title or obtain title insurance to make sure property taxes are paid and paid current, and check all the various issues out there that we need to do in traditional retail type sales, because a few more things can arise in those situations versus the subject to transaction. So when we're putting together that sub-to deal, as I said earlier, the most important part starts with disclose, disclose, disclose. It's having a quality contract with quality disclosures and disclosures that meet your state's requirements, whatever those might be. For instance, here in Texas, we have the underlying lien disclosure notice, as well as a new insurance disclosure notice that every seller must provide every buyer. That means an investor or owner-occupant in these types of transactions that are out there. Having good contract documentation is so important. Having time to review that before you close so that they can seek counsel, all of that is so important in a subject to transaction. Now, a direct seller finance deal is a little bit easier because we don't have any compliance issues. The property code isn't going to affect us in the great majority of our states out there. Again, though, you should make certain that it's okay for a seller to provide you a loan, and there's not any requirements for them to provide you certain disclosures in whatever state you might be in. But typically, a direct seller finance transaction is going to have much fewer disclosures required, much easier to structure, and you can put that deal together pretty much any way you want to do it. And it's going to wind up having a first lien mortgage on that property between the buyer and the seller. If you flip over to a subject to transaction for a moment, we're taking over that loan subject to the existing debt, just like a direct seller finance deal, we may need to borrow money for our down payment. We might need to borrow money for our repairs and rehab, maybe a little bit of interest carry. And that might be in a second lien, just like we can go borrow money on a direct owner finance through a private lender and put them in a second lien position as well. So guys, creative financing is an awesome industry. Learning how to navigate both the subject to transaction as well as the direct seller finance transaction is important. Understanding how to negotiate both, how to structure both, how to disclose both, all so important. So guys, I hope you liked this video, and if you did, don't forget to like it. If you got comments about it or other videos you would like to see or hear about, take a minute and comment below, and subscribe to our YouTube channel as well. In addition, if you want to learn more about creative finance and the proper way of doing things, take a minute and visit us over at theownerfinancenetwork.com. We're going to find tons of free videos, our training videos, and all of the items you need and all the services that you need for your next creative finance transaction. Guys, I'll see y'all next time.